There's been a lot happening across Australia in the last year, and certainly a lot happening in property development. With that in mind, it's certainly important to keep track of what are the GST consequences where it relates to property. This can make the difference between a profitable project and a poor outcome on a project. So you need to get it right either on sale or purchase. You also have to keep in mind the tax office is very vigilant where it comes to property developers and ensuring they don't leak GST where it involves property. So what are the most common mistakes that we see that you need to be abreast of with property? So problem number one, and we see this a lot, is not agreeing the margin scheme in the contract. If you don't agree the margin scheme in the contract on a residential lot, well, it means you're going to have to pay the full 1/11th GST on sale. So certainly a big no-no, you need to get this right. Two, what do we often see? Property developers buying pre-existing residential premises that have been lived in, can be occupied, and paying GST on those properties. This might mean that you can't use the margin scheme at all. It's normally going to be the case that you don't have to pay GST on that type of purchase. Third big no-no, and one the tax office are very vigilant with, is when you're building residential premises and apartments, if you intend to actually rent those out later and hold them long term, you can't actually claim the GST back. So this is a very important thing to know, because that's the difference between big cash flow impact when you have to pay those GST credits back, or you haven't factored into your cash flow or profitability modelling. We see these types of common GST mistakes happening all the time. To view more about these common GST mistakes and tips on how to avoid them, go to businessdepot.com.au/learn or call us on 07 3193 3000.